had a good result for the first half of FY18, an EBITDAF of 51.1 million, which was strongly underpinned by strong improvement in gross margin in our Australian retail business, which was our load was up 8% to 9.6 terawatt hours in Australia, which in a declining market is a pretty mighty effort. Most importantly, though, we delivered about a gross margin of a little over $5 per megawatt hour. Our outlook for the year had been a gross margin of $4.40. So you can see at the halfway mark, we're quite ahead of the run rate. In fact, we've upgraded our outlook for the full year to $4.70 per megawatt hour. I'll touch on that later. Equally importantly, for the 7th year straight, we have been named number one in terms of customer satisfaction in commercial and industrial. That's not a small effort. That's a survey that's run independently with 300 randomly selected commercial industrial customers in Australia participate in a 45-minute interview. Our result was 92% of our customers were either satisfied or very satisfied, which is an outstanding result. The next nearest guy was at 60. Importantly, of the 8 that were not satisfied or very satisfied, they were neutral. There was no customers in that sample that were either dissatisfied or very dissatisfied. That's the reason why we're able to continue to grow in the market. That high preference that we have with customers gives us then an industry-leading recontracting rate, which when you add that to us winning our fair share of new business, sees us continue to grow half over half. It also gives us the permission from the customer to talk to them about how they can use their energy more effectively. And this is something that we've been talking about for the last couple of years. We want to work with customers not only on getting them a good deal on their supply, but also helping them use their energy more effectively to get better productivity out of their energy, which is a real sustainable differentiator for us. Particularly when you think the last 18 months, there have been such price shocks in commercial and industrial, driven by the increase in wholesale pricing, that more and more customers are coming to us and saying, I need your help with both supply and demand. And as I said, that's an important differentiator because none of our large competitors, AGL, Origin, EA, who are long in the wholesale market with large amounts of coal-fired generation, they don't want to help customers use less energy or use energy more effectively. So that's a real differentiator that we have that's starting to bear fruit. As you see, our energy solutions business for the half was revenue of about 10 million, so it's still in early days, but that was up 143%. We expect to continue to invest and grow that business. The US business was a bit of a mixed bag. We had good growth. In fact, we doubled our load over the prior comparative period from 1.5 terawatt hours to 3 terawatt hours in the first half of energy, and we're outlooking about 6.5 terawatt hours for the full year. So good growth in load, but as we talked about at the last result, we are not achieving the gross margins that we would like. There are some learning effects in how we're operating, particularly in the PJM market, and we expect it will take us a few more results before we're starting to see the gross margins that will lead us to a good sustained profit contributor. In fact, we've called 2020 as the break-even year for that business in the US, where we will build enough scale to get our OPEX down and have our trading operating effectively to give us the gross margins that we require. Generation delivered well, on track, a little bit above in our Western Australian peaker at Neerabup that had some more opportunity to operate on its own account, a little bit below in Oki, which is subject to the volatility or the lack of volatility in the Queensland market, which has been affected by the government's directions to Stanwell to bid down their prices. We declared a 3.5 fully franked dividend, and we announced a buyback of $20 million, which I'll touch on further down the track. Just a little bit on the outlook. Australian business is looking good. We've forecast with outlook a sales volume of 19 terawatt hours at a gross margin of $4.70, which is an upgrade on where we were at the start of the year. And we do believe that there's some upside opportunity in that. It's not hard to look at the run rate if you're 9.6 and $5.08 at half time. We're looking pretty good on our Australian numbers. US 6.5 terawatt hours. We've downgraded our load as well as our gross margin for those reasons that I explained before. So we think that's at risk, though we are on track to meet our OPEX number there. All of the rest of the business is on track. The other thing I will point out is that we have upgraded our sort of midterm view or our 3-year view of our Australian gross margins. And we think that will range between $4 and $5.50. The other thing that we did was we ranged the NPAT outcome of the LGC strategy, so the short surrender of green certificates that we completed last year, and we think that will deliver between $35 and $45 million worth of NPAT to us in FY19 and 20, with the weight of that being to FY20. And then a little bit on capital management, if you want to jump to the next chart. ERM traditionally hadn't communicated to the market as to how we thought about cash and what we would do with excess cash. And so we spent some time on that at this most recent announcement. It's a pretty simple strategy. We figure out how much money we need to run the business and make sure that we have cash set aside to meet our prudential requirements. We then look at the money that we want to put away for dividends. So we've sort of declared that sort of 7 cents fully franked is what our sort of annual baseline dividend will look like. We then think about what sort of cash that we want to keep in the business for inorganic growth. And we've sort of declared that we think about $40 million is the right amount for us to keep as a war chest when we look at opportunities in energy solutions and the US to go and fuel incremental growth to the business. And that left us with about $20 million, which we would choose to return to shareholders in the most effective way. And in this instance, we thought the best way to get value for shareholders and for the business was to implement a share buyback.